Something just happened to silver that the financial industry has been quietly dreading for years. And the reason you haven't heard about it is not because it isn't important. It's because the people who understood it first needed time to position themselves before the rest of the world caught on. Here is the one number I want you to hold in your mind before we go any further. For every single ounce of real physical silver that exists in the world right now, there are almost 8 paper promises of that same ounce floating around in the financial system. 8 paper ounces for every 1 real ounce. And a rule that just came into force is about to make that math completely unsustainable for the banks running it. When that math breaks down, something has to give. And historically, when paper and physical reality collide in a commodity market, the move that follows is not small. Hi, my name is Janelle. Welcome to Janelle Decoded. Come for the finance and stay for the rule change they never announced. So in this video, I want to walk you through exactly what is happening to silver right now, why almost no regular investor has connected the pieces yet, what history tells us happens when these specific conditions line up, and what the 3 signals are that I personally watch to track where we are in this setup. By the end of this video, you are going to understand something that the vast majority of people with money in the market have no idea is happening underneath them. So let's get into it. Let me start with something most people have never looked at. Not a price, a ratio, because prices move around for all kinds of reasons. Inflation, a war, a tweet, someone with a big platform saying something loud on television. Prices carry a lot of noise. Ratios are cleaner. A ratio strips out the noise and just tells you how one thing compares to another in pure relative terms. The ratio I want to show you is silver divided by the S&P 500. How cheap or how expensive is silver compared to the American stock market? If silver is very expensive relative to stocks, that number is high. If silver is very cheap relative to stocks, that number is low. Simple equation. Now here is the important part. Right now, that ratio is sitting near one of the lowest readings in 50 years. That means silver compared to the broader stock market is almost as cheap as it has ever been in modern financial history. And here is what that has meant every single time it happened before. In the late 1990s, when this ratio bottomed out, silver subsequently went on a major multi-year run. In 2001, when the ratio hit another extreme low, the same thing followed. In 2011, silver reached roughly 2.5 times its current level relative to the stock market. That is a 250% move compared to where we sit today. And the biggest spike of all happened in the 1980s when silver was trading at roughly 30 times higher relative to stocks than it is right now. 30 times. Every single extreme low in this ratio over the last 50 years was followed by a major rally in silver. Everyone. The chart is not an opinion. It is 50 years of data. And right now, we are sitting at one of the most extreme lows that data has ever recorded. Now, that alone would be an interesting setup, but that is not the full story. The ratio is just the compass. It tells you where we are. What I really want you to understand is why this setup is different from the previous ones, because this time there are forces underneath the market that did not exist in 2011 or 2001 or the 1980s, forces that are structural, regulatory, and geopolitical all at the same time. So let's talk about the rule change, the one Wall Street would genuinely prefer you never fully understood. For decades, big banks have been running something called unallocated silver. That term sounds technical, but the concept is completely straightforward. Unallocated means the bank says they have the silver, but there is no specific physical bar sitting in a specific vault with your name on it. It is a paper promise, an IOU. And banks use this IOU system to build enormous trading positions where for every 1 ounce of real physical silver in existence, many multiples of paper ounces were circulating through the financial system simultaneously. At its worst, this leverage ratio was dozens to 1. Right now, it sits at approximately 7.6 paper ounces for every real ounce, still completely disconnected from physical reality. The paper market was not tracking silver. It was tracking promises about silver. And those promises were being used to keep the paper price manageable, to allow large trading books to function, and to give the impression of liquidity that the physical market could never actually support. Then a regulatory framework called Basel III changed everything. And this is the specific mechanism that most financial commentators either do not understand or are not interested in explaining clearly. Under Basel III, and specifically under something called the net stable funding ratio, holding unallocated silver, that paper IOU silver, suddenly costs banks real money. For every $100 of unallocated silver a bank holds on its books, it now needs to keep $85 in cash or cash equivalent sitting behind it as a buffer. Write that number down, 85%. What used to be a profit center that generated easy returns with minimal capital requirements became almost overnight a cost center that bleeds money. The economics of running a massive paper silver book flipped from attractive to painful with a single regulatory update. No press conference, no headline, just a rule change buried in a banking framework document that almost nobody reads. So what are banks doing? Quietly, in the background, they are being pushed out of the paper silver market entirely and into real physical allocated silver, actual bars, metal you can touch. And some major institutions have already walked away from silver clearing completely. That is not a rumor, it is public record. Now think about what that means for the market structure. For decades, the paper silver system gave large players the ability to manage price by creating and selling paper ounces that had no physical backing. That mechanism is now becoming expensive to run. As banks exit the paper market and demand increases for physical metal, two things happen simultaneously. The demand for real silver goes up, and the ability to artificially suppress the price goes down. The floor under silver just got structurally higher. Nobody sent you a notification about it, and the United States has not even fully implemented Basel III yet. The US is behind most other major economies on this. The UK implementation is expected within the next year. When the US catches up, the pressure on the paper silver system intensifies further. Now here is the second force hitting the market at exactly the same time, and it is a perfect companion to the first. China controls an estimated 60 to 70% of the world's refined silver processing capacity, not 10%, not 30%. 60 to 70% of global refined silver exports flow through Chinese refiners. That is an extraordinary concentration of a critical commodity in a single country's hands. At the start of this year, China replaced its decades-old silver export system with a strict licensing structure. Silver no longer leaves China the way it used to. Only a small number of approved firms can export. The open flow of refined silver out of China has been replaced by a controlled gate. And when China closes that gate even partially, every solar manufacturer, every electronics plant, every industrial buyer outside of China suddenly has to compete harder for whatever physical silver remains accessible in the global market. The timing of this is not coincidental. China has been watching the Basel III development closely. They understand exactly what pushing banks toward physical silver means for global demand, and tightening their export controls at precisely this moment concentrates even more pricing power in their hands. This is not a country that makes these moves by accident. So now let's talk about the demand side, because this is where the story gets genuinely staggering. Most people think of silver as a precious metal. Something for jewelry, something for coins, something wealthy people buy as an inflation hedge. And while that is true, it is maybe 20% of the story. The other 80% is industrial, and it is growing faster than almost any analyst predicted 5 years ago. The solar industry alone consumes 20% of the entire world's annual silver supply. 1 in every 5 ounces of silver mined on Earth goes into solar panels, and that number is not stable. It is climbing every year as solar panel efficiency improvements actually require more silver per panel, not less. The most advanced solar cell designs use silver paste as a conductor in ways that cannot currently be substituted with cheaper materials without significant efficiency loss. Electric vehicles use roughly double the silver of a conventional combustion engine car. Think about every circuit, every sensor, every power management system inside a modern EV. Silver is in all of it. And EV production globally is still in its early scaling phase. The demand curve is pointing up steeply. Then there is artificial intelligence. Every data center running large language models and AI inference systems requires massive amounts of power management infrastructure. Silver is the best electrical conductor on Earth. It is in every high-performance connection, every advanced circuit board, every component where reliability under high electrical load load matters. The AI hardware build-out happening right now is a silver demand event that nobody in the mainstream financial press is connecting to the silver market. Add 5G infrastructure, advanced medical devices, defense electronics, satellite systems. Every technology sector that is growing fast is a silver demand sector. And unlike gold, which sits in vaults and can be recycled back into the market relatively easily, industrial silver gets consumed. It gets used up in applications where recovering it is economically difficult. It leaves the available supply permanently. Now let's look at what is happening to supply, because this is where the math starts to look genuinely uncomfortable for anyone who needs physical silver. The world has been consuming more silver than it produces for 6 consecutive years. 6 years in a row, the global silver market has run a deficit. We are burning through stockpiles that took decades to build. It is like spending from your savings account every single month without ever making a deposit. You can do it for a while. You cannot do it forever. On the American side, the main commodity exchange where silver futures are traded, the COMEX, has been watching its physical vaults drain at an alarming pace. A year ago, there were 114 million ounces of registered silver in those vaults. That number dropped to 76 million ounces. The paper futures market is supposed to be backed by physical metal sitting in those vaults. When the vaults drain, the connection between paper promises and physical reality gets thinner and thinner. Now, I want to be careful here because some people will tell you the COMEX is about to run out of silver, and that is not exactly accurate. There is additional silver classified as eligible in those vaults that could be converted to registered status. So it is not an imminent crisis in those vaults specifically. But the trend is undeniable. The tighter physical availability gets, and the more Basel III pushes banks toward demanding real metal rather than paper promises, the more stress builds in the system between what is promised on paper and what actually physically exists. Large industrial buyers, solar companies, EV manufacturers, data center operators are pulling real metal out of the system faster than it is being replenished by mining. Wealthy investors and sovereign funds locking in physical silver are putting it into private storage that is unlikely to come back to market for decades. When institutional money buys physical silver with a multi-decade time horizon, that metal effectively disappears from the available supply. And in a single month earlier this year, China imported 836 tons of silver. To put that in context, that was 78% more than the month before, and 170% above their 10-year monthly average. Chinese retail investors who got priced out of gold started buying silver as the accessible alternative. The Chinese solar industry was front-loading purchases ahead of policy changes, both happening at the same time, pulling enormous quantities of physical silver into China at the exact moment China was tightening its export controls, metal going in one direction through one door while the exit door was being locked. Now let's connect this to the broader financial picture. Because silver does not exist in isolation, and understanding what is happening in the bond market and with the dollar helps explain why this particular moment in history is uniquely significant for silver. When bond yields go up and the cost of holding dollars in treasuries becomes more attractive, money tends to flow toward financial assets and away from commodities. That dynamic kept a lid on silver and gold for much of the last decade. But right now, bond yields are elevated at the same time that confidence in the dollar's long-term purchasing power is genuinely under question in ways it has not been for a generation. Foreign central banks have been selling U.S. treasuries and buying gold at the fastest pace in modern history. That is documented. It is not a fringe theory. It is the official data from central bank reporting. And where gold goes, silver historically follows, but with more velocity. Silver tends to lag gold in the early stages of a precious metals move and then dramatically outperform once the move is established. That lag and catch-up pattern has repeated in every major precious metals cycle for the last 50 years. The bond market stress we are seeing right now, with the U.S. 10-year yield sitting at levels that start to create genuine pressure on the federal debt math, is not a background event. It is directly connected to the silver story. Because if the Fed eventually has to step back into the bond market and resume purchasing treasuries to prevent a debt spiral, the inflation implications of that decision are exactly the conditions under which silver has historically made its biggest moves. Now, here is the historical context that I think is the most important thing I can give you in this video because patterns matter, and the pattern here has been remarkably consistent. In 1973, the Arab oil embargo created a supply shock that markets took weeks to fully price in. After the initial ceasefire announcement, the S&P actually went up. People thought the worst was over. Then reality hit and the market fell another 40%. The same delayed response pattern has played out in commodity markets repeatedly. The paper market holds, the official story holds, and then physical reality becomes too large to manage, and the price moves violently to close the gap. Silver in 2011 went from around $18 an ounce to nearly $50 in roughly 8 months. That is a 170% move in less than a year, and that move happened without Basel III, without China controlling 70% of refined exports, without a 6-year consecutive supply deficit, without AI and solar demand running at current levels, without the dollar's reserve status being questioned the way it is today. The setup in 2011 had maybe two of the factors that are currently converging simultaneously. Right now, you have all of them at the same time. So let me give you the framework, 3 signals, the way I personally track where we are in this setup. So I am not guessing and I am not reacting emotionally to price moves. Signal 1 is the ratio, silver compared to the S&P 500. When that number is near historic lows the way it is right now, the risk reward of having silver exposure shifts meaningfully in your favor. This is your North Star. It does not tell you exactly when the move happens, but it tells you clearly that we are in the part of the cycle where historically the opportunity has been significant. Check it regularly. Know where it sits relative to its 50-year range. Signal 2 is the supply and demand balance. Every year, the Silver Institute publishes the World Silver Survey. It reports in plain numbers whether the world used more silver than it produced. We are 6 years into consecutive deficits. Watch that number annually. If the deficit continues at the current pace, you do not need to predict the future. You just need to understand that less supply and more demand is not a complicated equation. The direction it points is not ambiguous. Signal 3 is the rule book. The biggest price movements in financial history do not start with a viral tweet or a dramatic headline. They start with a quiet regulatory change that rewires the incentive structure of the entire market. Basel III pushing banks from paper silver into physical silver is a rule change. The U.S. critical mineral designation for silver is a rule change. China's export licensing overhaul is a rule change. 3 structural rule changes hitting the same market simultaneously is not background noise. It is a convergence that historically precedes major moves. When all 3 signals line up, extreme ratio low, persistent supply deficit, and simultaneous rule changes restructuring demand, that is the pattern that Wall Street pattern recognition has flagged before every major silver event in the last half century. Now, before I close, I want to be completely honest with you because I think that matters more than making everything sound guaranteed. Silver is volatile. More volatile than gold, more volatile than a broad stock index. It can drop 10% in a week for reasons that have nothing obvious to do with the fundamentals we just discussed. The same structural forces that make the upside case compelling also mean that when silver moves against you, it can move hard. After the 1980s peak, silver fell severely. After 2011, it gave back most of its gains over the following years. The forces that drive explosive moves up are the same forces that can make the drawdowns brutal. If a 20% drop in the value of a position would cause you to panic and sell, this is not an asset to go heavily into regardless of how compelling the setup looks. This is an asset to size thoughtfully, understand deeply, and hold with a clear plan as part of a broader strategy. The framework is a checklist, not a guarantee. It is a way to replace gut feelings and emotional reactions with a structured reading of where we actually are in the cycle. Here is what I keep coming back to when I look at this setup. The ratio is at a 50-year low. The world is 6 years into a supply deficit with no sign of it reversing. 3 simultaneous structural rule changes just restructured the demand side of the entire market. Industrial demand from solar, EVs, and AI hardware is accelerating. China just locked its export door while pulling record amounts of metal inward. Basel III is pushing banks out of paper and into physical, and almost no retail investor has connected all of those pieces yet. That window does not stay open indefinitely. At some point, the paper market and the physical reality have to converge. They always have. You cannot print physical atoms. And when perception catches up to physical reality in a market that has been running a 6-year deficit with 8 paper ounces for every real one, the move that follows that convergence is historically not a gentle one. Let's see what happens. Drop your thoughts in the comments below. I genuinely want to know what you are seeing and what you are doing about it. If you want to go deeper on how I am personally thinking about positioning for this environment, there is a video linked above. As always, smash the like button, subscribe if you have not already, and I will see you next week.